Welcome students to this series of lecture on fixed income. And in this series of lecture on fixed income, today we are going to be discussing the price yield relationship again. And this is the second session on the price yield relationship or price and market interest rate relationship, price yield relationship. And the focus of today's session is sensitivity. So from the last session, actually, we started the discussion of relationship between bond prices and market interest rate, bond prices and market interest rate. And we'll continue discussing the price yield relationship or price market interest rate relationship for at least the next 3 to 4 session because this is one of the most important concept in fixed income. But today's session is especially important because today we are going to introduce a very critical concept in fixed income, which is duration. Heavily tested in CFA, heavily tested in FRM, and also very commonly asked question in any interview on analytics, financial analytics. However, before you understand this session, my strong recommendation is that you should have watched the previous session on the price yield relationship, because in that session, we established two most important concepts. The first concept that we discussed in that session, the first concept that we discussed in that session is that bond prices and interest rate have an inverse relationship between themselves, which means if interest rate or yield rises, if interest rate or yield rises, the bond price will fall. And if interest rate falls, the bond prices will rise. And this was the first concept, and the second concept that we established was that this relationship is not linear. It is convex. It is convex. Definitely, it is inverse, but it doesn't mean it is linear or a straight line. It is convex. So today, we will build on that understanding. So therefore, it is necessary that you go back and watch the previous session on the price yield relationship. We already know that if interest rate falls, the bond prices will rise. And if interest rate rises, then the bond prices will fall. Interest rate falls, bond prices rises, interest rate rises, bond prices will fall. But the question is by how much? Can we measure the magnitude of this rise and fall? What is the magnitude of this rise and the fall? This rise and this fall, how much? And that magnitude is actually captured through duration. That magnitude is duration. We call it duration. So, in a very simple language, if I have to define the word duration, please do not confuse it with the maturity of the bond. No, it's not maturity of the bond. It is the sensitivity of the bond price, not maturity. It is the sensitivity of the bond price with respect to interest rate. And if I want to define it exactly as per the CFA and FRM curriculum, then duration is on an average. What is the percentage change in the bond price due to 1% change in interest rate? So if interest rate changes by 1%, then on an average, how much is the percentage change in the bond price? So what is the definition of duration of a bond? On an average, percentage change in the bond price, not absolute, percentage change in the bond price due to 1% change in interest rate, which simply mean that we have to calculate the sensitivity of the bond price. We have to calculate the magnitude of the sensitivity of the bond price with respect to interest rate. So for example, you have two bond 1, bond 2, or example 1, example 2. Bond 1 has a duration of 3. Somebody calculated it for you. And bond 2 has a duration of 10. Then how would you interpret it? So if interest rate changes by 1%, then for bond 1, the bond price will change by 3% in opposite direction, approximately or on an average. Or if interest rate rises by 1%, then the bond price will fall by on an average 3% or approximately 3%. Now example 2, if the duration of bond 2 is 10, What does that mean? It means that if interest rate changes by 1%, then the bond price will change by, on an average or approximately 10% in opposite direction. So if interest rate fall by 1%, bond prices will rise by, on an average, 10%. And if interest rate rises by 1%, then the bond price will fall by, on an average, 10%. Now the question is, think carefully. You know about what is the interpretation. You covered interpretation. Now the investment question is, which bond would you buy? The answer is, it depends upon your forecasting or your opinion on the future interest rate or the future of interest rate. For example, suppose you believe that the central bank or the RBI or the central bank of the country or the government is going to reduce the interest rate, maybe because of an expansionary monetary policy. Which bond would you prefer? Which bond you would prefer? Will you prefer bond 1 or will you prefer bond 2 to buy? Definitely you will buy the bond with the higher duration, because if interest rate falls, the bond with the duration of 10 will rise by approximately 10%. However, the bond with the duration of 3 will only rise by 3%. But this is scenario 1, where the interest rate was supposed to, or your belief was, will fall. But what if, as per your assumption or reading the market, your assumption is interest rate are going to rise? Then you would avoid holding the bond with duration 10, because the bond price will fall by 10% if the interest rate in the market will rise by 1%. In fact, in fact, if you are, suppose you're holding both the bonds and suddenly you get the information that the central bank is going to increase the interest rate, then most likely you would first liquidate the bond with higher duration, which is duration of 10. So you will liquidate example 2 or bond 2. And that's why, think carefully, from the investment perspective, from the risk management perspective, duration becomes extremely important for investment decision, for risk management, for portfolio management. And that's why we are studying duration. Okay, now solve one simple example. The example is, the central bank decided to rate cut by 2% because of some expansionary policy. What would be the change in the bond price if the duration of the bond is 5 and the bond price is 985? Okay, so you have to find out the change in the bond price and what would be the final bond price. I'm repeating the question. Read this question and you have to find two values. What would be the change in the bond price and what would be the final bond price after the rate cut of 2%? Now, before I solve the question, I would strongly encourage that you all pause the video and try to solve this question yourself. Because if you're able to solve this question correctly, then your interpretation of duration is becoming strong. You already have that intuition. Okay, so let's solve it. The duration of bond is what? 5, which means that if interest rate changes by 1%, then the bond price will change on an average by 5% in opposite direction. And here the interest rate is falling by what? 2%. Duration is 5, interest rate is going to change by 2%. So the bond price should rise or will rise or maybe rise by approximately 2 into 5, that is 10%. 10% of what? The existing bond price, which is 985. So it would be 98.5. So the answer to one of the question or first question is 98.5. The bond price will change by 98.5 in opposite direction of the change of the interest rate, and the interest rate is going to fall. So it will rise and the final price is going to be 985 plus 98.5. And this is approximate. And the final value is going to be, if you sum it, will be 1083.5. Correct? So the final bond price is approximately 1083.5. But now comes a very important question. How did we get the duration as 5? Or in the previous example, this example or this example, how did we get the duration as 3 or 10? Because I never explained you all how duration is actually calculated. And this is where fixed income start becoming complex and interesting, because calculating duration is not straightforward. It's not straightforward. We have to calculate what? Duration of the bond. but it is not straightforward. Why? Listen very carefully. Because for different bond, the duration will be different. Number one. Number two, even for the same bond, the duration will change with time, or duration will change because of change in interest rate in the market. Suppose today a bond has a maturity of 5 years and you calculated the duration, say 3.5. But tomorrow, the maturity will become 4 years and 364 days. The duration has already changed because duration is dependent on the time as well. It is not equal to maturity, but it is dependent upon the maturity of the bond. We'll see that. Similarly, if market interest rate changes or market yield changes, the duration will change. So it is challenging to calculate the duration. The third challenge is that there are different methods to calculate duration. Effective duration, Macaulay's duration, modified duration. Which duration should we use? It depends upon the situation. We'll study that. And that's why we are going to spend significant time in understanding duration calculation properly. Now let's start with one example. Suppose we have a bond which has a face value of 1000, coupon 6%, frequency of the coupon is annual, maturity 3 year, I by Y is 7%. Interest rate in the market is 7%, and you have to calculate the duration of the bond. We have to calculate the duration of the bond, and you all will calculate the duration of the bond. That is the assignment. But how to approach it? What is the definition of duration? It is the sensitivity of the bond price to interest rate. It is the sensitivity of the bond price to the interest rate. So it is actually the percentage change in the bond price due to 1% change in the interest rate. So what you have to do, you have to change the interest rate by 1%. And then you will try to find out what is the change in the bond price. But the problem is you don't have to calculate the absolute change in the bond price. You have to calculate the percentage change in the bond price. This is problem number one. The problem number two is if you want to change the interest rate by 1%. So you're saying, oh, let's change the interest rate from 7% to 8%. Let's calculate the new bond price. Now, if I say change the interest rate by 1% in the downward direction, then there will be a different bond price. Now, we have proved in the last session the change in this direction and the change in this direction. The change for the increase and the change for the decrease in the interest rate would be different for the bond prices. So, how would you calculate the duration of the bond? We established in the last session that the price yield curve is a convex curve. It's not a straight line. And because it is convex, the rise is greater than fall. Please watch the session. Then how would you calculate the duration? So this is your assignment. Try to solve it for today. And in the next session, I'll solve this question for you and we'll get to the final formula of duration. So what is the next session is about? Next session is about deriving the formula of duration, which is written in a book. We are not going to mug up the formula. We will derive the formula for duration. Okay, with that, I'll pause the session. Thank you. Have a nice day.